think we'll get started. Welcome to the Pay or Be Paid on Your Terms Executive Series. I'm Stephanie Nelson, the VP of Commercialization and Growth at Prime Revenue, and I'll be your host for today. Some quick housekeeping I wanted to share. This is a 30-minute working session. You will be muted, but please feel free to ask questions through the chat functionality. We'll be running 3 polls along the way, so make sure you have access to your computer or screen so that you can participate. And then, of course, at the end, we'll have a live Q&A where you can drop questions in the chat function again, and we'll answer as many as we can before time runs out. As a reminder, today we're focused on working capital optimization, specifically why most programs plateau and what the companies that don't plateau are doing differently. To walk us through this, I'm joined by Eric Riddle, our Chief Commercial Officer at Prime Revenue. He's spent the better part of 20 years working with CFOs and treasurers at Fortune 500 companies on exactly this topic. So Eric, over to you.
Thank you, Stephanie. Good morning, and good morning to you all on the call, or good afternoon if you happen to be in Europe. Glad you had the foresight to join us today. Looking forward to an interesting working session over the next 20 minutes or so. We're going to break the conversation really into 2 concepts. The first concept is most corporations set out to achieve some sort of a working capital objective when they implement a program, but there is a distinct separation between working capital as a business initiative and the program that may support it. They are kept separate in concept because linking the 2 of them, if you've been around the industry long enough, presents potential risk for accounting treatment reclassification. So I'm going to have 2 distinct pieces of conversation, one on working capital optimization and one on the program that supports it. Programs do stall, and today we're going to talk about why. So first, let's start with the concept of working capital optimization. When I first got into supply chain finance and the concept of reverse factoring and was learning about factoring itself, there was usually a specific dollar amount or a specific use for the capital that was generated or unlocked as a result of a program or an initiative. Today, it's become more of a business imperative. We call it an initiative here, but companies have progressed past the idea of just unlocking 50 million, 100 million, or 200 million dollars just for specific use, such as a share buyback or capital expense or some other expenditure. Where the progression has led us to today, 20 years later, really, I would say in the last several years, is a much more distinct focus on working capital or cash use in the business. So reducing working capital as a percentage of sales has become the focus. And we're going to talk a lot about why. Number 1, shareholders reward it. So a more capital efficient business leads to higher total shareholder return, shareholder value. Those that have implemented controls over their cash conversion cycle, the most distinct effector of working capital efficiency, tend to thrive above the rest, above their peer group in disruption environments, supply chain disruption environments like we experience through the pandemic period and like we're experiencing now as it relates to the price of oil due to the conflict in Iran. And then companies that have been slow historically to adopt working capital efficiency control mechanisms typically struggle to catch up to those that have optimized themselves over a longer period of time. So for those reasons, a more corporate level focus on overall cash use efficiency in the business and working capital optimization has become a more distinct focus that we see emerging as we talk to clients on a day-to-day basis. So looking at the pre-registration list, I think we have a mix of participants in the call today. We've got some practitioners that are in the space. We've got some industry analysts that are in the space. We've got funders in the space, and we've got some corporates in the space. So Stephanie and I would really like to get your view on a few of these poll questions. And the first one, if we don't mind advancing to the next one. So do you have a working capital optimization initiative in place today? So this is not necessarily have an SCF program, but does your corporation, or if you're a practitioner or an industry participant, think about a corporate that you know of or the general rule that you experience on a day-to-day basis. Does the corporate that you work with or the corporates that you work with, do they have specific working capital optimization initiatives in place? Couple more seconds.
Evenly split between yes, defined initiative with specific cash deployment targets, and yes, focused on it, but no formal initiative.
Okay. I think that's probably, in today's environment, that's probably a good representation of what we would typically see as a program provider working with our clients. So I think that's a really good representation and a good place to start. Okay. So let's talk about the programs let's talk about the initiatives themselves and why this is critically important. So if you are one of the respondents that said you don't have a specific initiative, here is why you might consider doing so. Here is why you might consider this as a business initiative as opposed to a point solution to generate cash. Um, Earlier in my time with Prime Revenue many years ago, we had the opportunity to work with a large home improvement operation that had specific designated use of the capital they were unlocking by a payment terms extension, which was to build their new stores. They were in a growth mode, and every 10 or $15 million that they unlocked from their SEF program, they used to build a new big box operation, essentially debt free. So there was a very specific use. They weren't thinking about cash optimization in the business or reducing capital deployed in the business. They were thinking about a very specific way to spend it as a capital expense. In today's environment, companies that have a specific focus on cash conversion cycle control and efficiency in operation, they have a 10-day overall 10-day advantage in the cash conversion cycle as compared to the rest of the class. So the top quartile outperforms the rest by 10 days. Then you can do the math on what 10 days of cash use efficiency in the cash conversion cycle means to a corporation based on its revenue. They also specifically have a 6-day advantage as it relates to days sales outstandings. And this is in an environment of disruption. So in a disruptive environment such as what we have today, or that we experienced during the pandemic period, or the one that we will experience 5 years from now, controlling capital in the business, having levers that you can pull when needed, have a very positive effect. The net effect is the free cash flow conversion or the cash travel rate through the business for companies that have this control before the disruption tend to accelerate cash 1.6 times faster than companies that do not. And thanks to Ernst & Young, EY Parthenon for putting this study together. They pulled data from S&P's Capital IQ, their clients and others to come up with these statistics. And I'm grateful for their efforts here because it really helps us tell the story that if you don't have a corporate initiative around working capital efficiency, you probably should, especially if you're in a capital intensive environment or industry. So now we're going to transition from the importance of having a working capital initiative at the corporate level, thinking about it as a cash use efficiency or working capital efficiency program, to linking it to a supply chain finance program that supports it or helps offset the impositions that might be made in the supply chain or the corporate's position in the supply chain, depending on if it's payables or receivables. 20 years ago, these were considered point solutions, as I mentioned earlier. Today, they're considered a control mechanism. And EY Parthenon has proven the linkage to shareholder value through some of their research efforts of having an effective control over the cash conversion cycle. So SEF programs can be very, very powerful. but they are driven and they are consumed and they are active based on the working capital initiatives of the corporate. Okay, so in today's environment, a true holistic uh, supply chain finance program, thinking of the customer in both receivables and payables terms, has many different flavors or types of solutions that can be deployed to affect many more outcomes than simply just working capital. So when I hear of a program that's stalled, or I hear of a program that doesn't have an initiative, I have had several visits with clients recently and I always ask the question, are you done with affecting or improving working capital efficiency in your business? And every CFO or every treasurer I speak to says, absolutely not. We are completely focused on it. Well, okay, it doesn't feel that way as your program provider. So I think there's a different way to think about a more holistic approach to cash use efficiency and working capital management. To the upper right here, we talk a lot about obviously optimizing the cash conversion cycle. We talk about margin improvement. If I hear from a CFO that they've got excess capital that's not performing and they'd like to put some of that capital to work in a program that offers no risk, I'm talking about dynamic discounting here. There is an opportunity to either account for that as an improvement of margin or yield on idle cash. If they're concerned about financial sustainability within their supply chain, thinking about their suppliers' disruption risk, they can talk about, we can talk to them about opportunities to improve financial sustainability of the supply chain, not just their own financial sustainability. There are AP efficiency benefits that can be affected by the modern supply chain finance program. I mean, I'm not talking about just prime revenue, despite this being a prime revenue webinar. This is true for many of the providers that are offering these programs today. But the programs are not effective or not relevant unless the initiative is in place and the corporate will is in place to affect the use of the program. Finally, security and fraud resistance associated with digital payments versus paper payments, check payments here in the US, which still plagues up to 45% of the pay volume, the payment methods in the US by US corporations is still check, if you can believe it, if you're listening in from Europe. So think of both your receivables view into your customer base and the buyer view into your supplier base. There are multiple flavors of SCF that can be deployed to allow you to affect the lever control you have over your cash conversion cycle so as to meet the needs either of shareholder pressure on reducing working capital in the business as a percentage of sales, or simply just reducing risk and the ability to adjust to disruption that you feel in either the demand or the supply chain. So I think we have another poll coming up.
Yep. Yeah, thank you, Eric. That was great. All right, so on to our second poll. If you have an SCF program in place, or if you're an industry provider and you can think of this in a different little bit of a realm of how your customers will respond, why did you initially implement it? There's 5 options on the screen. Take about 15 seconds to respond and we'll share the results.
It's a good question. Sometimes we see a lot of mature programs that have been around for 10 years, 15 years, and it's always interesting to understand why they were initially implemented and have they progressed based on the conversation we've been having this morning. Have they progressed effectively over time?
Yeah, so what we've heard from our audience is we're tied actually with 40% selecting to achieve a specific cash or working capital target, and another 40% selecting to optimize overall working capital deployed across our business. So those were our top. The only other one that anyone selected was to offload working capital responsibility to suppliers via term extension.
Got it. Okay. Well, we can advance. I'm sure those that said we're trying to optimize working capital efficiency across our business are patronizing us, having learned a little bit in the last 10 minutes or so. But so let's advance and we'll talk about the next stage. So that's great for those that answered at all. Greatly appreciated. The those that have said that they have progressed to optimizing overall working capital in the business, kudos to you. You are a modern performer and you're thinking about things the way that the top quartile in the EY Parthenon survey or the EY Parthenon research has indicated. So what I have seen, and I think what our business has seen over time, is when these programs, not the working capital initiative, but when the programs, when they plateau and when they stop growing, when suppliers stop joining or new customers of our corporate client stop joining a receivables program, it's usually because corporate will has waned. The pressure to deliver working capital optimization or improvement on the optimization has sort of drifted. There isn't a specific objective in place. There's usually a corporate will issue at play there. The second issue is balance sheet scrutiny. So I have seen some very large programs in my experience, my personal experience. These are programs that might have $1 billion and a half, up to $2 billion in overall working capital deployed for the benefit of the program. And at some point in time, a chief accounting officer or a CFO or somewhere in the business will start to get concerned about the size of the off-balance sheet treatment that exists for these traditional reverse factoring programs. And then they'll shutter the payables program as a result of that. So corporate will, number one. Second most common reason for plateau is when the program gets so large, it starts to be concerning from an off-balance sheet treatment. And then third, programs become limited to penetration into the supply chain beyond the initial top of the chain into the more mid and long tail, what we call tactical and strategic spend. There are usually conditions of participation, such as minimum trade values, minimum trade volumes, that many funders apply to the joining of the program onto suppliers. So if a supplier can't make a minimum $50,000 trade, they are not eligible for the program. And that just is a way for the banks to more or less control the workload associated with the opportunity to earn revenue, which is completely understandable. So those are the three main reasons that we typically see, having operated hundreds of programs over a period of 20 years. We see these three things. I think, if you don't mind moving on, moderator, to the next slide, we'll talk about how do we fix this? How do we address? How do we help programs grow to that point? I want to talk about a case study example. This is a client that is a client of Prime Revenue. I'll protect their interests by not mentioning their name, but suffice to say, I think this program is probably one of the largest programs in the world as it relates to supplier participation and overall value delivered. This program has, in the traditional SCF sense, a reverse factoring program, they have 1,700 suppliers that are participating in a traditional reverse factoring program funded by 5 different capital providers or banks. In addition to the traditional SCF program, there's another 2,000 that are participating in a payment agent program in partnership with Prime Revenue and a couple of those funding banks. These are rapid enrollment, no KYC, far more scalable to reach the mid and long tail of the supply chain. It allows us to have a deeper penetration into the supply chain to reach those that have financial sustainability issues, or there are maybe security perceptions of security risk on the buyer side where they'd like to digitize payment flows to a broad section of the supply chain. This particular program has has been focused on working capital improvement, but also has been focused on many of the other outcomes or potential benefits that we spoke about earlier, including efficiency, AP efficiency. So it's generated on the receivable side about 276 million in working capital improvement alone. So pretty significant benefit with a broad base of participation of the supplier community. I presented this slide at a recent panel discussion, and I think if I were to ask the group, stand up if you have 1,700 suppliers on your SCF program, no one in the room would have stood up. I think this is a very large program and represents a lot of innovation and creativity on supplier onboarding. So if we don't mind, I think we've got another one of our last poll. We'll jump to that and then we'll move to wrap up.
Thank you, Eric. So after everything you've heard today, which element of the cash conversion cycle are you most focused on improving? Again, there's five options, so please take 15 seconds to fill in your answer and we'll share the results.
Yeah, this is a good one. I mean, when I think about this, having been around this industry for quite some time, I think about the access to working capital impact and the speed to working capital impact and the overall needs of the business. And I'm not sure, I am not confident that all the CFOs and treasurers that I speak with see the control of inventory on the balance sheet as a supply chain finance solution. And it is a critical part of the cash conversion cycle, so it should be considered. But if someone were talking to me about pace of rapid impact on working capital improvement, I'd probably steer one of these solutions direction. If someone were talking about low cost access to working capital, I'd probably go in a different direction. Quite fascinating.
It was 67% chose the first option, and that was accounts payable. So primarily everyone is focused on accounts payable.
Yeah, again, thank you to the moderator. Again, that's a completely plausible representation of the industry in general. I think we still live in a world where when someone thinks about SCF, the definition is the term is used so liberally that it can mean many different things, but most think of it as traditional reverse factoring payables finance, which is probably the longest to materialize in terms of working capital inputs because of the process of negotiating a payment term with a supplier, establishing a new payment term, and then introducing the offsetting tool of SCF behind it. Whereas receivables can be much faster, or post-maturing payables finance, where the extension of the payment term is completely within the buyer's control, is a much faster means to get access to capital, a much lower lift in that sense. So I hope that this is very brief conversation and this distinct conversation about making working capital optimization or capital use in the business as a percentage of sales is one way to measure it, was a valuable conversation. And the programs that support those initiatives different. Our hope is that we may have expanded your thinking to think about working capital much more broadly than a single lever. It's a combination of levers. And why should you care, or why should your clients care if you're an industry participant? It's because disruption is a normal course of life these days, and those that have controls in advance of that disruption in place are rewarded handsomely relative to their peers. It's where they accelerate. It's an opportunity for the well-trained athlete to accelerate on the hill and leave the rest behind. If you'd like more information, if you'd like to just share some ideas with us, please go ahead and scan the QR code. We'd be happy to engage in a conversation. I think we've got very little time left, but happy to take a question or two. I saw one pop into the chat.
Say, Eric, we have a good question that came in Why is the utilization of SCF higher by quarter end, and who triggers it, the buyer or the suppliers? I think that's a great question to end on.
Yeah, it's a really good question. Well, I think we all know that because of the pace of traditional SCF, a buyer would have a very difficult time deciding at the end of the quarter to negotiate a bunch of payment terms legitimately and therefore push their payment term past the quarter end date so as to retain cash in that quarter. There was, I talked about a big box retailer that I had some experience with many years ago at Prime Revenue. One of their suppliers happened to be a very large appliance manufacturer who was also part of the portfolio of customers of Prime Revenue. So we got to see this dynamic firsthand in that situation. And usually, if you think about it, to sell your receivables, to accelerate payment, to sell receivables, reduce receivables on the balance sheet is a positive pull on that lever, on the DSO lever in the cash conversion cycle. To push payments is a positive pull on the lever to increase DPO. So usually, especially if it's a public company, you'll see a massive sale of receivable to the extent they're eligible to be sold at quarter end periods to affect reporting. Either it's a tenant of a finance arrangement they might have with one of their banks. It might be a public, it might be a lead in to a quarterly financial release or a quarterly financial statement. But typically it just shows your corporate's ability to pull a lever and control the nimbleness of their cash conversion cycle. And that's typically why we saw it in the past. I think that's probably the most prevalent reason why someone would do that.
Okay,
So
thank you. Thank you, Eric, very much. And thank you all for the time that you've spent with us today. Any questions we didn't get to, we'll definitely respond by email, so look out for those. You'll also receive a copy of the recording from this session in your email in about 24 hours. So please reach out. Again, if you scan the QR code, we'll be in touch.